everyone. Well, what a day. It feels like we've done a whole week and we're only on Monday. But obviously, the big news, the main story, the main price to watch today is the oil price, which of course surged above that $100 a barrel level. I'm going to look straight in the charts now because that's, let's face it, it's the price action of the day. So we are going to look at all the charts. This is one of our X station charts, and it will show you what oil is doing. Now, this is Brent crude oil. Brent crude oil spiked. If you follow the chart on the right hand side, you can see where I am. That had risen to $120 per barrel. That was such a momentous move overnight, and it comes on the back of fears about supply in the Gulf, because lots of Gulf countries are now shutting down their supply, and they have to because they can't get the oil out of the region because of the closure of the Strait of Hormuz. There was lots of stories about that over the weekend. There was a big escalation in the war as well. Oil really responded to that. So we had closed at we'd kind of closed just below that kind of 80 level, just above the 90 level on Friday, just below $95, and then we absolutely surged to 120. Now we saw something similar in WTI as well. In fact, WTI surged by $27. Very unusual move. That would be if it had held on to those gains, which it didn't, and I will talk about that in a moment. That would have been its biggest increase ever. So this really does show that this conflict is having a huge impact on oil, and oil is really, really dominating. However, as you can see, it's a red candle. So we have come back on the day. We're currently trading below $100 a barrel for Brent crude. We're at $98 for Brent. We're about $93 for WTI. Remember, Brent typically trades with a higher premium than WTI. If we just go back, if we just look at the 5-year chart here, we're at the higher, we had been at the highest level since 2022. Now, a lot of people say to me, well, what is $100 oil? What does it mean? Is this opportunity to buy the dips in places? Well, if I look at, $100 oil, $100 is a key psychological level, without a shadow of a doubt. It changes it changes economic and financial market dynamics. It raises the specter of inflation, just like we saw after 2022, when inflation, particularly in the UK, but also in the US and throughout Europe, really, really spiked sharply, and that's what led to interest rates having to be increased really, really quickly, and that was seen as being a bit of a chokehold on economic growth, although economies did recover from that crisis. But it's not a good thing to have such a elevated oil price. But someone asked me today, well, what does $100 oil mean? Aside from the economic impacts, the problem with $100 oil is that it tends to be very sticky, and there can be quite a big overhang of $100 oil. So, for example, back in 2022, and this is about WTI numbers actually, not Brent, but fairly similar. In 2022, the crude oil price stayed above $100 a barrel for 87 days. The average since 2008, when oil is broken above $100 per barrel, is that it stays there for 140 days. So it's not just a matter of weeks, it tends to be a matter of months. And that's the real big problem here. That's why we're seeing so much worry and fear spread throughout financial markets. Now, if I just make this, put this on a shorter time frame, then as you can see, we spiked to nearly 120 and we've fallen throughout the day. Now, why have we fallen here? Why have we given back the best part of $22 in Brent crude oil? Well, that comes down to reserve talks. So the G7 finance ministers, they're meeting. They are meeting today. In fact, they still are meeting. We're still waiting for the official statement, but it seems like they are going to take coordinated action to release reserves. So a multilateral release of strategic oil reserves. Now that will increase the supply of oil, which is triggering this decline in crude. Now, this is a very headline-driven market, both on the upside and the downside. So as you can see today, it's been on the downside. So those people looking for oil at 150, they've been thwarted today. This near-term injection of supply is certainly helping markets to recover. But the shock has not passed, and I really would be very, very clear in that. The Strait of Hormuz is still closed, supply is still constrained, and although these G7 reserves are definitely cushioning the blow, they're not necessarily going to be a long-term solution to the crisis. We need the Strait of Hormuz to open up. So this has definitely injected some optimism into the market, and it's optimism that governments and policymakers in the West, in the economies that are going to really struggle from an oil price shock, that they can act as like a buffer to this energy price squeeze essentially that we're seeing. So what we've seen is a big recovery, or a downside in oil. What I should say is recovery elsewhere. Let's take a look at what this means for the Nasdaq. Well, the Nasdaq's been really, really interesting because, as you can see here, the Nasdaq hasn't actually come off all that much. It's down about 3%. Now, partly that is because those software stocks that were sold off so sharply earlier this year, so in January and February time, where we saw big declines for the likes of AppLovin, we saw huge declines for like Salesforce, IBM, all of these massive software firms, even Microsoft actually, well, they made a bit of a comeback last week, and they were the second best performing sector after oil and commodities. So something quite strange is going on, that in the US is maybe seen as being a little bit more cushioned, and it is more cushioned from the blow of a war in the Middle East. Even though, of course, it's been started by Donald Trump, it seems like it's a bit of a lower stakes war for the US compared to elsewhere. So we've seen US stocks outperform Europe in the last week. Now, that is a complete 180 from what it was earlier in the year, when European stocks were flying high and US stocks were struggling, and they were actually posting losses for the year before this conflict happened. So something quite interesting going on there. I think that we've got... I think that we're kind of we're still a very headline driven and fluid market, but I do think it's really worth noting that, oil does tend to stick around that $100 a barrel mark. That's going to be worse for Europe than it is for the US. And tech, I still think that we're in a bull cycle for tech. And the fact that we've only dropped 3% during this crisis, and this crisis has escalated a lot. We're now, earlier today, we were living through a full-blown energy supply shock, and that's something that I haven't even lived through. So there's a lot going on, and the fact that the Nasdaq is only down 3%, that really does suggest that it's very, very resilient, and that tech is acting in some ways as a bit of a hedge. But I think the better argument is that actually there's a bit of bargain hunting going on. And where's the safest place to bargain hunt at the moment? Well, maybe not Europe, because you've got this fear of stagflation and fear of an inflation jump. Maybe the best place is actually going to be in the US, in those those really unloved sectors of tech, like the software stocks, that really got sold off too much because there was those big fears about AI, and actually they're looking really attractive from a valuation perspective, so maybe people are jumping straight in. Now, the other thing that's been quite surprising for a lot of people is gold. Gold is still down. It's just under that 5,100 dollar per ounce level now, and it's really not been a fantastic hedge or safe haven during this crisis. As you can see, it's just like one big candlestick after another. If I just look at it on a daily basis, that seems to have gone a bit funny, but if we just look at it on the year, so we have really backed away from those highs. Obviously, we had that real sharp high earlier this year, but we are backing away from those highs in the gold price. And whilst we remain above $5,000 per ounce, it does suggest that this isn't the harbour in the storm. And that gold is very much essentially being treated like equities. So that is something that's quite interesting, I think. Now, I'd also like to share with you a different screen. So just bear with me for one moment, guys, and we will go from there. This is, again, just showing you what equities are doing. That's still Brent. This is showing you what commodities are still doing. So yes, Brent crude below $100 per barrel, but still up 7% today, 63% on the year. Natural gas, if you follow my point there, up 5% on the day, up 100% on the year. If you look at equity markets, as you can see, they really pulled back. There were such sharp losses earlier today, and you can see that in what went on with Europe. So a 5% decline in the Nikkei, to nearly 3% decline in the Australian index. We saw, near 3% declines for the Euro stocks earlier. That's all come away now. So they're clawing back those losses. They're still down over the last five days. But as you can see here, where my pointer is, big declines, especially on a currency adjusted basis versus the US there. So US S&P 500 down about 2.5%, and the Euro Stoxx down about just under 6 for the past 5 days, but it had been down 3% today. It's now down 0.6%. So there's been a big recovery in market. There were a big recovery in markets before Europe closed, and again, kind of moderate losses considering where we are with things in US stocks as well. Now, part of the reason is bond yields. Bond yields are in recovery mode as well because of that better feeling around the oil price. So as you can see, the 10-year yield was up 12 basis points at one point today for the UK. It's now up 1.8. And again, United States yields were up. The 10-year Treasury yield was up 10 basis points, is now down 1.7. European yields are also lower. So that suggests that we're seeing a real calming in the market. What it also shows is that there's kind of one major dominant macro trade at the moment, and that is oil. So the fall in that oil price is having a huge impact and is reverberating through other financial markets. So for example, for example, we've got it in bond markets. We've also got it in equity markets as well. So equity markets are recovering, so are bond markets, all because of that decline in the oil price, even though the oil price does remain close to 100. And I would just say, just be aware that the oil price tends to be sticky around that 100 level. So 87 days WTI spent above $100 per barrel in 2022. Now, one very strange thing that happened today was interest rate expectations in the UK. That 120 surge in the Brent crude price to $120 per barrel. That triggered a complete 180 about turn in interest rate cut expectations in the UK. Not that long ago, do you remember we were looking at an 80% cut at next week's meeting for the Bank of England? Well, that is not the case now. Now there's no cut expected. In fact, there's no cut expected for the whole year. They're currently pricing in about 0.1, 0.2%, 0.2 cuts, 0.2 by the way, by middle of the year, and then actually by just under a year's time, there's every chance that the market is trying to price in interest rate hikes. So we're currently at 3.75%. And in a year's time, we're just above 3.75. If you just look here, so that's current market pricing for the UK. So absolutely no change in interest rates expected. Now, at one point today, a full rate hike had been priced in by the market. So again, the fall in the oil price has definitely ameliorated things for the interest rate futures market. But a really, really busy day. We've had huge amount going on. Oil price, it was up, it was down. Now it's kind of settling just below that $100 barrel mark. But do be aware that tends to be a sticky level. But we are very much in a fluid market. We're in a really fluid market, but we're also in a headline-driven market. So headlines both on the upside and the downside. So anything that's kind of positive coming out of the region, ceasefire, potentially the falling of the Iranian regime as well, that could be seen as good news, and that would weigh on the oil price and then boost things like bonds, stocks, and possibly lead to make it easier, certainly for some central banks to cut interest rates this year and not have to hike any more. Bad news, and we just see that stagflationary trend really upend global financial markets. So thank you so much for joining again today. I know it's been a really long day. It's not over yet. That dominant macro trade is still the oil price. So thank you so much for joining, guys.